Have you ever pondered what it takes to create wealth beyond measure? It's a thought that has likely crossed your mind. The secret to unimaginable wealth isn't buried in a treasure chest, it's woven into the fabric of investment strategies. It's about understanding the methods that have propelled others to success. And one name stands out in this regard. So let's delve into a journey of wealth creation, investment, and financial wisdom. What if someone told you that the answer lies in the journey of one man, Warren Buffett? You've probably heard the name Warren Buffett, the Oracle of Omaha. But who is this man, and how did he become one of the wealthiest and most respected investors on the planet? Let's take a quick journey through time to understand the man behind the wealth. Born in Omaha, Nebraska in the early 1930s, Warren Buffett was not born with a silver spoon in his mouth. His father was a stockbroker and later a congressman, but young Warren was always eager to make his own wealth. As a child, he sold chewing gum door to door and delivered newspapers. He even bought a used pinball machine and placed it in a barbershop, earning money each time someone played a game. These early ventures ignited a spark in Warren that would later transform into a roaring fire. From a young age, Warren was intrigued by the world of investing. At 11 years old, he bought his first stock. By the time he was 16, he had amassed over $2,000 from his various business ventures. This was the 1940s, mind you, when $2,000 was a substantial sum of money. But Warren didn't stop there. He was relentless in his pursuit of knowledge and understanding of the investment world. After graduating from the University of Nebraska at 19, he applied to Harvard Business School but was rejected. Undeterred, Warren discovered a book by Benjamin Graham on value investing and was so impressed that he applied to Columbia Business School, where Graham taught. He was accepted, and it was here under Graham's mentorship that Buffett honed his investment philosophy. Buffett's approach to investing was not about making quick money. He studied companies for their long-term value and potential, a strategy that would eventually become his trademark. He became an influential figure in the world of finance, not just for his wealth, but for his wisdom and his unwavering belief in long-term, value-driven investing. So, what makes Warren Buffett's investment strategy so successful? Warren Buffett's investment strategy is deceptively simple, yet incredibly effective. This strategy is built on a few core principles that have guided Buffett throughout his illustrious career. Firstly, Buffett is a proponent of long-term investing. He is not interested in quick wins or overnight sensations. Instead, he opts for investments that will yield returns over a period of years or even decades. This approach is often likened to gardening. You plant a seed, nurture it over time, and patiently wait for it to grow into a mighty tree. In the same vein, Buffett invests in companies that have strong fundamentals and growth potential, and then patiently waits for the investment to bear fruit. Secondly, Buffett is a value investor. He looks for stocks that are undervalued by the market, believing that their true worth will eventually be recognized. He once famously said, "Price is what you pay, value is what you get." This means that he doesn't focus on the current market price of a stock, but rather its intrinsic value. He buys stocks when they're undervalued and holds on to them until their true value is realized. Finally, Buffett believes in investing in what you know. He calls this his Circle of Competence. Buffett sticks to industries and companies he understands thoroughly. He believes that it's better to invest in a few companies that you know inside and out, rather than spreading your investments thin across many sectors you barely understand. Overall, patience, discipline, and understanding are the cornerstones of Buffett's approach. He takes his time to thoroughly research potential investments, stays disciplined in his value investing approach, and never strays from his circle of competence. But let's not underestimate the complexity behind this seemingly simple strategy. It requires a deep understanding of the business, the market, and the ability to stay disciplined even when the market goes against you. It's a strategy that requires patience and discipline in equal measure. This strategy may seem simple, but its implementation requires a deep understanding and discipline. Buffett is a firm believer in long-term investment. This approach to investing has been key to his success, and is a cornerstone of his philosophy. Now let's delve into this concept and understand how it has worked to his advantage. Long-term investment is the practice of buying and holding assets for an extended period, often several years or decades. It's like planting a seed and patiently waiting for it to grow into a tree. This approach is based on the belief that while markets may fluctuate in the short term, over the long haul, they generally trend upward. Buffett has often used this strategy to his advantage. He doesn't buy a stock with the intention of selling it after a quick profit. Instead, he invests in companies that he believes have strong fundamentals, a competitive advantage, and growth potential. He then holds on to these investments through the market's ups and downs, allowing him to reap the benefits of compounding returns. Compounding returns, or the ability to earn returns on both your original investment and the returns that investment has already generated, is a powerful wealth-building tool. It's like a snowball rolling down a hill, gaining more and more momentum as it goes. The longer you can keep the snowball rolling, the bigger it gets. This approach also mitigates the risks associated with short-term market volatility. By staying invested for the long term, Buffett avoids the pitfalls of trying to time the market, a strategy that often leads to buying high and selling low. Instead, he focuses on the intrinsic value of companies and stays the course, regardless of market conditions. Of course, long-term investment requires patience, discipline, and a tolerance for volatility. It's not a strategy for those looking for quick wins or instant gratification. But for those willing to play the long game, it can yield substantial rewards. As Buffett famously said, "Our favorite holding period is forever." This statement embodies his belief in the power of long-term investing and serves as a testament to his enduring success in the world of finance. Another cornerstone of Buffett's strategy is value investing. Now let's dive deeper into this intriguing concept. Value investing, in the simplest terms, is about finding diamonds in the rough. It's a strategy that involves seeking out stocks that are priced less than their intrinsic value. Imagine you're at a yard sale and you spot a vintage baseball card. To the untrained eye, it might seem like a piece of cardboard, but to the knowledgeable collector, it's a gold mine. That's the essence of value investing. Spotting worth where others may not. Warren Buffett, like the baseball card collector, has a keen eye for undervalued stocks. He doesn't just look at the current price, he examines the company's fundamentals, its business model, its competitive advantage, and its potential for long-term growth. If the company's intrinsic value, derived from these factors, is higher than the current market price, it's a signal to buy. But the key to value investing isn't just about buying, it's also about patience. You see, the market doesn't always recognize a company's true value immediately. Sometimes it can take years for the market to catch up. During this time, the value investor must exhibit patience and hold on to the stock. Think of it like this: you plant a seed, but the tree doesn't grow overnight. It takes time, nurturing, and patience. The same goes for value investing. You buy a stock at a bargain price and then you wait. You wait for the company to grow, for its earnings to increase, and for the market to finally recognize its true value. And when that happens, the price of the stock rises, and the value investor reaps the benefits. It's like buying a painting from an unknown artist and then selling it for millions when they become famous. In essence, Buffett buys quality companies for less than their worth. And that, my friends, is the beauty of value investing, the art of discerning value where others see none, and the patience to wait for the market to recognize it. It's not a quick scheme to get rich, but a calculated strategy to build wealth over time. Buffett advocates for investing in what you know, or staying within your circle of competence. This circle of competence, as he calls it, represents the range of businesses or industries that you understand profoundly. It's about recognizing your strengths and limitations in knowledge and expertise. Now, you might be wondering, why is this circle of competence so crucial in investing? Well, let's delve into that. Warren Buffett, one of the most successful investors of our time, strongly believes in the principle of investing in what you understand. By doing so, he claims to reduce the risk associated with his investments. This approach allows him to make informed decisions based on his deep understanding of a business, its operations, and its potential for growth. For instance, if you're an expert in technology, you would have a better understanding of tech companies, their products, the market trends, and the potential threats and opportunities. This knowledge equips you to make informed investment decisions in this sector, thereby reducing your risk and increasing your chances of success. But here's the catch. The circle of competence isn't static, it expands as you grow and learn. So, if you're passionate about an industry or a business but don't understand it well enough yet, don't fret. Keep learning, keep growing, and gradually, that industry or business will fall within your circle of competence. However, it's equally important not to overestimate your circle of competence. Overconfidence can lead to risky bets and significant losses. Remember, it's not about the size of the circle but knowing its boundaries. So how does one identify their circle of competence? Start by assessing your knowledge and understanding of different industries. Reflect on your experiences, your skills, and your interests. This self-awareness will guide you in identifying your circle of competence and making smart investment decisions. By sticking to what he knows, Buffett minimizes risk and maximizes return. This principle of the circle of competence is a key element of his investment strategy, and it could very well be a game changer for yours too. So how can we apply Buffett's investment strategy to our own investing journey, you might ask? Well, it's not a clandestine secret locked away in a vault. It's a path paved with understanding, patience, and discipline. Firstly, understanding is key. It's about comprehending the business you're investing in. You wouldn't buy a car without knowing what's under the hood, would you? Similarly, you shouldn't invest in a business without understanding its operations, its market position, and its potential for growth. So, do your homework. Dive deep into the company's financials, study the industry trends, and analyze the competitive landscape. Next, patience is vital. The stock market isn't a get-rich-quick scheme. It's more like a tree that needs time to grow and bear fruit. Warren Buffett himself once said, "The stock market is a device for transferring money from the impatient to the patient." So resist the urge to jump on the latest hot stock or to panic when the market dips. Instead, stick to your investment plan and let time do its magic. Finally, discipline is the backbone of successful investing. It means staying true to your investment strategy even when the market is volatile and your emotions are running high. It's about making decisions based on logic and analysis, not on fear or greed. Remember, the market is a roller coaster ride, and it's the disciplined investors who stay on the ride till the end who reap the rewards. But let's not forget, even Buffett didn't become a billionaire overnight. He made his fortune over many decades through a series of smart, well-thought-out investments. He didn't let market fluctuations sway him from his strategy. Instead, he stayed the course, patiently and disciplined, trusting in his understanding of the businesses he invested in. Remember, investing is a marathon, not a sprint. So take your time, do your research, and stay disciplined. That's how you apply the Buffett Way in your own investing journey. That's how you build wealth the Warren Buffett way. Warren Buffett's journey and his investment strategy hold invaluable lessons for all of us. As we come to the end of our exploration, let's take a moment to reflect on the wisdom we've gleaned from one of the most successful investors of all time. Warren Buffett's approach to investing, encapsulated in the concept of the Buffett Way, underscores the importance of long-term investments, value investing, and understanding your circle of competence. Remember, it's not about quick wins or short-term gains. The magic happens when you commit to the long haul. Patience, persistence, and a clear perspective can make all the difference. As Buffett has proven time and again, embracing long-term investments is a surefire way to secure a prosperous future. Value investing, another cornerstone of Buffett's strategy, is all about finding and investing in undervalued companies. This involves a deep understanding of a company's intrinsic value, which goes beyond just looking at its price tag. It's about understanding the company, its business model, its competitive advantage, and its potential for growth. And let's not forget the concept of the circle of competence. This idea is all about focusing on what you know best and not straying too far from your area of expertise. It's about leveraging your knowledge and understanding to make informed investment decisions. Buffett himself has been known to shy away from industries and technologies he doesn't fully understand, a testament to the power of staying within your circle of competence. But remember, these aren't just abstract concepts or theoretical ideas. They are practical, actionable strategies that you can start applying in your own investment journey today. The key is to understand these principles, internalize them, and then put them into practice. Investing, like any other skill, requires practice and patience. It's not about getting rich quick, but about growing your wealth steadily over time. And as you embark on this journey, remember to keep learning, keep growing, and keep investing in yourself. So let's take these lessons from Warren Buffett to heart. Let's embrace the long-term value investing and the circle of competence. Let's commit to continuous learning and growth. Let's transform our financial futures. As we wrap up, let's remember this powerful quote from the man himself. The best investment you can make is an investment in yourself. Let's make it our mantra as we navigate the world of investing. After all, the journey to financial success begins with investing in our knowledge, our skills, and our potential. As Buffett himself said, the best investment you can make is an investment in yourself.